Standard approaches to risk analysis presume well-defined probability specifications of the macroeconomic uncertainty that's priced by security markets. How do recent events alter how we think about this source of uncertainty and its quantification? What are the implications for bond and equity markets in the euro area?
So I'm moving in the meantime over here, save some time. So I hope you all heard the question and I didn't distract you. It's a very, I think, topical question, and it follows on well with the previous comments that we just heard about the regulatory environment. So I brought, as you do, some slides, and I promise to be very brief. If you wouldn't mind projecting them here so I can see them. They're coming. There they are. So, yeah, sure, we're full of uncertainty, definitely around the place I work, and I would say one of the big sources of uncertainty has been the recession itself, where we were used to this great moderation data generating process, and all of a sudden we got a number here and a number there. And so it's taking us time, I would think, just to refresh the contours of that distribution on macro outcomes, and then over that distribution try to price assets. Now, I would contend that we're on Wall Street not that slow. And I think the work of academics has been very useful to us. We have Homer Schiller on my desk, The Interest of Interest Rates. So we know that we've been with low interest rates also in the past. We have terribly good work by Rogoff and Reinhardt about financial crises. And now we have a whole branch developing on economic archaeology with contributions for Barrow and others, for instance, that basically tell us that the true population is actually much richer than we make it to be. And if you take that population, then you can price out a lot of the premia that we observe in markets. So I think we're gradually catching up with that. And as a matter of fact, on the topic of growth, and I think it relates to the first question, when you're given a survey measure of US GDP growth for the next 5 to 10 years, that number has gone from 3.25 to 2.5 over the last 2 years. So there has been an adaptation to this new regime. Now, my emphasis here is on a different type of uncertainty, and I put here, tongue-in-cheek, there are not many 80-year-olders to ask about how did it look in 29 and 33. And that has to do with a more behavioral type of uncertainty, the one we live through as investors. And I know that's not hot in Chicago to think about the world this way, but to me, having lived through the past 20 years of financial history of Europe in particular, and having observed how people panicked when they didn't have a trading experience that spanned more than 10 years, that idea of direct recollection of events became very important. The other thing I wanted to highlight at this general stage is a difference between uncertainty and ambiguity. And I think there has been great work done exactly at Chicago on this distinction. So what I mean by ambiguity is kind of a second-order sort of uncertainty, when you just don't know how the distribution will look like in the future. And I think you'll agree with me that the history of the European crisis has been all but ambiguous. We had, for instance, the Greek PSI, the private sector involvement. That represented to many of us a too big to fail issue. Investors, a bit like when they were pricing agency debt in the States, thought these bonds were close substitutes to treasuries, and then came PSI, and there was a revelation that ex post that was not the case. And I think that led up to a new consideration. How should we think about long-dated claims offered by any of these European governments? And then came the other ambiguity, which is the EMU breakup. Now, if you talk to any lawyers, they'll tell you that is an extra-institutional event. So even they don't know what exactly we're going to be facing if EMU breaks up. And so, particularly since November last year, we've received a lot of calls from very apprehensive managers trying to shape the distribution, and we weren't particularly helpful. Last but not least, we have what we discussed, the regulatory framework, which is changing Sharpe ratios. I thought of giving you a few pictures, so I chose out of the suite two that I found more interesting than others. This is a relationship between Italian BTPs, 10-year government bonds, and German bonds. And the relationship is fitted from 1992 onwards. And the model is very simple. It relates this differential in yields to macroeconomic factors. The factors are relative growth, relative deficit, and relative debt. So fiscal and growth. And it does a fairly decent work in getting the turning points. I circled two places where we were scratching our head, the convergence pre-EMU, that's the first circle. Then we had the conundrum, spreads were too narrow. But by and large, these were within out-of-sample standard deviations. And then came the PSI, and in order to reconcile that big spike in Italian spreads, you either had to think that the market was completely bonkers, or you had to give a lot of loading to debt as opposed to flows. And that, I think, also explains why Italy has underperformed Spain, which so far, on a flow measure, was doing much worse. Similarly, we had an event that changed the picture completely around. That was the LTRO by the ECB. And I think that illustrates to me that some of these risks that we're facing nowadays are of two natures. One, they're very ambiguous because we haven't got tools to treat them or think of them critically. EMU exit, for instance. And secondly, they're very systematic. What moved Italian spreads up and then down were European events. Very little to do, unfortunately, with the good work Monti is doing over there. Next picture, I think, hopefully tallies into some of the neat work Cochrane has done on the discount factors. And this is my very primitive way of looking at the bond premium. So this is a statistical object that you're looking at. It's very, very simple. The way you want to think about it is as follows. Imagine you have a government bond portfolio of 10-year AAAs, and you try to immunize this portfolio for macro circumstances, short rates, growth, inflation, what have you. And then you're asking yourself, is there a common factor that drives all yields in this portfolio of AAAs up and down over the business cycle, above and beyond the macro factors? And this is what this common factor looks like. Again, I call it bond premium for the lack of a better word. Interesting things have happened. For instance, in the late 90s, central banks became independent. Inflation expectations changed and became more anchored, and the bond premium collapsed. And we lived through a long period of time when the premium was relatively stable over a lower mean. And then all of a sudden, hell broke loose, again through the PSI. And nowadays, you can't look anywhere but find real rates which are very close to zero, be it Brazil or Europe, US. And I think this speaks about this paying up for capital insurance that investors have. Asset markets have rallied, and I'm going to spend 1 minute only on Europe, which is going to come up sometime here. And this is my Joan Miro of the evening. And again, it's, as you can tell, only for illustrative purposes. So does the retreat and risk, does the fact that markets have rallied, Italy's done so well, mean that the ambiguity is gone? And my contention is no. And this, I put it here, tongue-in-cheek, a Statler and Waldorf view. You remember the two characters from the Muppet Show, the curmudgeons. So I feel a bit like one of those kind of criticizing what good policymakers have done, but ultimately, you know, still coming back for the show and having a privileged seat. But we've gone from a very risky configuration with an intersection of cross-country ownership of assets, government bonds or bank claims, to a configuration that looks like the right-hand side panel. The ECB is acting as the clearinghouse. Everybody faces the ECB, and you don't have as much systemic risk. Does that mean that the risk has gone away? My contention is no. It's just residing on a different balance sheet and probably largely neutralized. So where do we stand? I think in terms of ambiguities, we still have a lot. We probably have a better scoring on growth because you don't have to sacrifice as much if interest rates stay low, thanks to central banks, and that scores probably better chance of seeing what Cochrane is arguing, structural growth reforms boosting us away from debt. But I think the deleveraging is still very much ahead of us, and then we're still faced with the ambiguity of how and what these claims actually look like. Let me end there, and thank you for your attention.
John, I'll give you the first chance to.
I just have two little pot shots. One, the point of an educational institution is so that we don't have to have direct memories, but we can pass on the lessons of our grandfathers. So in some sense, that's why we're here, to summarize history and not have to learn it all again the hard way. I think you pointed out something very important going on that I see in bond market, which is, of course, the flight to quality. It's been astounding for me. You know, every time the ECB bails out again and the Europeans bail something out again, I say, great, the euro is going to fall. That means my vacation is going to be cheaper next time I come. And every time it goes up again, that's kind of weird. Well, we kind of know what's going on. There's in both within Europe and Europe to U.S. It's kind of amazing that there's been this like two quality of government bonds that have, you know, very large debt to GDP ratios. I mean, we have, if you looked at the U.S. long-term debt projections as a business plan, and you walked into the bank with those, you wouldn't even get past the security guard. So we kind of know what's going on. There's this flight to quality. You know, the U.S. isn't going to officially default, but there comes a moment when flights to qualities reverse. And so I wouldn't take for granted those low interest rates forever and ever. Last point, the ECB graph. I liked the graph on the left. And I didn't regard it, I regard it as risk spread out all over the place rather than risk concentrated in one place, which is now where it is. I mean, basically all this southern sovereign risk is in the hands of the ECB. If it turns out it was just illiquidity, we'll be fine, because the ECB, when it comes time to tighten, they have all these wonderful bonds they can just sell, soak up off the euros. If it's hard to sell all those sovereign bonds that the ECB holds directly or by lending to banks who hold all those sovereign bonds, then we have €1.5 trillion euros or so sitting out there that requires German taxpayers in order to soak them up, or sits out there and causes inflation. So it is all centralized in the ECB, but risk can be sliced and diced. It can't be gotten rid of, and I don't sleep so well at night knowing that it's all in the big center in the middle.
Charles.
The PSI in Greece did not help in the sense that it led to a contagious fear that similar events might befall investors in sovereign debt in other countries. But I think on the whole that you put too much weight on that and not enough weight on the fact that all these states in the Eurozone were in effect borrowing in a foreign currency. They were very much like emerging markets. And the euro crisis was very much like a Calvo sudden stop, leading to a balance of payments crisis, as well as, and more serious than, in many respects, the fiscal crisis. The chart about the Italian spread going up did not, in my view, actually occur after or at the time of the PSI. What actually caused it is the trigger was when Berlusconi appeared to be attacking Tremonti, who was thought by the markets to have a reasonable grasp on what was needed for dealing with Italy's deficit and debt. And at that point, suddenly there was a realization that Italy and Spain were in play. It all happened, I remember very clearly, in July last year. And it wasn't the Greek PSI was the trigger. It was an appreciation about political difficulties leading to economic difficulties. Again, the tragedy of what has happened to the Eurozone has been that it was Greece that went first, because it has meant that everybody has tended to look at this as if it was a fiscal issue, well, primarily it was a cowboy sudden stop, and it's a balance of payments issue. And the problem is the inability of countries to adjust their competitiveness at a time when they can't adjust their exchange rate. And that's a very difficult thing to do.